We have a good group, so a few people still filtering in, but I think we should get started just for the sake of time. My name's Emily Kovac. I'm the editor of Cider Culture. I'm excited to welcome everyone to our fourth and final installment of Cider Business School, our partnership with ECOS, which I think has gone really well, and I really appreciate all the interest and all the people who have come to each class and accessed the videos afterwards or shared them with their colleagues. I hope it's been a good, helpful resource in this wild time. Our fourth session is about accounting, and so we have with us today Lou Catalano. Lou is a CPA who specializes in a range of services in the areas of tax, accounting, and consulting service. And we're thrilled to have him here because his specialty is working with small to mid-sized craft breweries, cideries, and wineries. So he knows our world. He knows the specific issues that people in the craft beverage industry face, which I think is a really cool niche to be in, that I think will be extra beneficial for us. So he's a regular speaker for the California Craft Brewers Association, and in his free time, dabbles in some home brewing and enjoys mountain biking and water sports with his wife and kids. So that's a little bit about Lou. Thank you so much for joining us and for your time.
Yeah, my pleasure.
I'm going to mute and let you jump right in.
Awesome. Thank you very much. Well, hey, everybody. Thank you so much for joining the webinar today. I know that your time is valuable, so, it just makes me feel honored that anybody wants to pay attention and listen to what I have to say. Like Emily said, I'm a CPA, work primarily with small and mid-sized businesses, and a major chunk of those are craft breweries, cideries, wineries, craft beverage, a few craft distilleries as well. So one of the cool things about doing what I do is I get to choose who I get to work with and the types of clients that I work with. And so I just really love being in this industry. The craft beverage industry, is really filled with people who are really passionate about what they do and about connecting with their community. And that's fun for me, and parallels well with kind of what I like to do, and hopefully adding value on the business side. We're going to talk accounting today specifically. We're not going to get into the weeds on, bookkeeping and things like that. But specifically, when we bring on new clients or when we're talking, we're talking with businesses. Oftentimes, what you're looking for is that next step of, well, what do I, I've got some numbers. Maybe we need some help wrangling those and getting those organized. That's fine. But now, what can I actually use those numbers for? How do I make my business more successful? And I can say that without fail, regardless of the industry that we work with, the businesses that we work with that are the most successful, the managers and owners, the key personnel of those businesses have a good sense of these. Sometimes it's internal. They may not have a fancy spreadsheet or accounting. Sometimes they just kind of know it instinctually. We like to try and quantify it a little bit better so that you can hand off and share responsibilities and things like that. In addition, man, with what's going on in the world right now, certainly in our industry with closures and dealing with different ABC rules and can people come in or not, and to go and selling online and all that kind of stuff. I just really want to commend everybody who's on this webinar or any of the webinars this week for, taking the time to invest in your business and work on your business instead of just in it. I know it's hard right now. You're being pulled in 1,000 different directions. So hopefully you get some good value out of what we're going to talk about today. And certainly, I believe the forum is open. I'm not sure exactly how they're doing it here. I apologize, but I believe the forum is open for you to type in questions. Otherwise, you can contact. My contact information will be available at the end as well. But I think we're going to have a Q&A session kind of at the end. So if you have any questions, please shoot those off, and those will be shot over to me to hopefully address at the end if I can. So with that, we're going to go ahead and get started. Again, we're developing key performance indicators for your business. That's my contact information. I'm out here in California on the West Coast, so it's a little closer to lunchtime for me right now. KPIs, first of all, let's just get some background. Let's understand what are they. And really a key performance indicator is a measurable value, a number that demonstrates in real numbers how effectively a cidery is achieving its key business objectives. These can range from high level focusing on, business performance to lower level focusing on process improvements in specific departments. So if we're trying to get a little bit more efficiency out of our sugar conversion, some of the basic stuff like that, or packaging, certainly what's our packaging loss or efficiency or dissolved oxygen, those sorts of things at the lower level. High level, of course, the biggest one being what's our bottom line, right? How much money are we putting to the bottom line? But there are a lot of intermediate kind of ideas there, but the key really is that it's a numerical value and that it's measurable. And then why do we use them is we want to use a KPI to monitor your key business functions to ensure your consistent performance. When you look at a financial statement, when I sit down and sit down with a client, if you don't spend a lot of time looking at a financial statement, looking at a balance sheet or a profit and loss statement is there's just a lot of lines and a lot of numbers, and it's hard to know where to look. What the KPIs really do and why we use them is it allows us to take all that data and really compile it down to one or two key areas that we can look at and manage to. So my definition here, we use them to monitor key business functions to ensure consistent performance in areas vital to the success of the overall business, or alternatively, we're using them as a way of tracking the effectiveness of process improvements. We make a change in our marketing strategy, or we bring in a new bottling or canning line or something like that. We use those KPIs to monitor, did that work or not, or is it meeting our expectations, things like that. And again, with the goal, we always want to have that end goal in mind of we're trying to improve the financial operation of our cidery. More money to the bottom line, we're going to be able to expand, pay our people more, obviously more profit available for the ownership group. We obviously need a source for where are we going to get our key performance indicators. First and foremost, I'm the CPA, so I'm going to tell you the accounting system. Accounting is all about tracking expenses and revenue, really at the end of the day. And one of the things that I think is really important to look at as you're beginning to grow the business, some of you, I'm sure, are already using an accrual basis or whatever, but timing is very important when we look at the accounting, and particularly when we're looking at KPIs. A very common, very easy KPI that most of you are probably monitoring and don't even know it is your gross margin. So, your total revenue divided by your cost of sales, cost of goods sold. How much did it cost to produce that product that you sold? Well, it's very important that we get our timing right on that, because if we do one bulk purchase of raw ingredients in, call it March, and that's going to stretch out for the next 6 months, we can't have all of those cost of sales sitting in our March numbers. We got to move those out. If we're using good inventory management, which we'll talk about a little bit, or if we're using an accrual basis of financials, that'll work. Oftentimes with small businesses, we're using a cash basis of financials, which is simply when we pay a bill, it's an expense. When we deposit a check, it's revenue. And that's totally fine. It's a valid way to do it. But when we get into the weeds a little bit more in developing KPIs, it might be something that we're going to have to, might be something we're going to have to look at a little bit further. The next area in the accounting system that we really leverage for KPI development is labor costs. That's, your raw goods and your labor costs are the primary drivers of your expenses and therefore your profitability in your business. And when we look at financials, we want to see those labor costs broken out by the department. So, if we've got back of the house production, if we've got a tap room where people are coming in, a tasting room where people are coming in and buying product, things like that, we want to have those separated out so that we can see each individual kind of revenue center. I like to think of it as each individual revenue stream needs to have the expenses appropriately associated with it. Again, we've got a POS system. So moving a little bit more in detail, our POS system is going to give us our sales by day. If we're, as more and more of us are moving to more and more online sales and doing that, I would include whatever software you're using for selling online in that kind of model of what are our day-to-day sales. That's going to have more of the nitty-gritty detail than your accounting system generally is. If you're on QuickBooks or something like that, we may be just pulling sales in once a day, whereas the POS system is going to have a lot more specific, and that's going to get us a little bit more detail. Particularly if you're running an entire restaurant, the POS becomes very important, so we can track our food costs versus our labor costs. There's a lot that gets built into those systems that allow us to build KPIs as well. Sometimes we're a lot more simple than that. Sometimes we're just running on QuickBooks, and that's totally fine, but that's going to be a good source of information for us. And finally, Our business management system, obviously, ECOS is the presenting partner here, and they've got an excellent system, and that really allows you to monitor your production throughout the process, get our costs in appropriately. That's going to make sure we've got that timing nailed down, because we're able to get, we're able to affiliate, a purchase with product actually flowing through our system from raw goods all the way to packaged and then finally sold product. So that's really, again, comes down to inventory, right? The inventory management. At its simplest, inventory management is really, you sit down with me at the end of the year, we're going to do your taxes, and I say, okay, how much inventory do you have left on hand? We write down a number and we make a journal entry. And there are times when that's okay, and it gets us pretty close. But if we're trying to get more sophisticated, we're trying to run a tighter ship as a business, being able to manage that inventory at a minimum, pulling in, monthly counts, better yet, using a brewery management system that's going to give you real-time inventory tracking that you have to adjust occasionally for shrinkage and stuff, but that is going to give you that real-time inventory tracking. That's going to give you the most dialed in numbers that we can use to feed into our KPIs that we've developed. So finally, we know where they are. The next question is, how do we create one? And the first step is always, we want to begin with the end in mind. So what are our critical business objectives that we're trying to accomplish? We can only track, and we only have so much space in our brains for monitoring this kind of stuff. And if you're a small business owner, like I think everybody on this call is, you wear a lot of different hats. You're spending a lot of time thinking about a lot of different things. So what I spend a lot of my time and energy doing is working with clients on how do we identify the 3 or 4 probably honestly is too many, 3 key areas that if we can focus on this number, we manage to this number, we know we're going to be doing pretty well. And similarly, we can bring in people on our team and have them manage to one number. They don't have to understand how the accounting works. They just have to understand how this one number works. So what are our business objectives? Ultimately, we want to be in business. We want to be profitable, right? But some of the shorter term business objectives that we might look at is increased efficiency. So again, that could be, better sugar conversion. It could be certainly in the packaging side, less loss, better quality product, things like that. Improving cash flow. Cash flow is an interesting animal in that it's very much tied to profitability and the revenue that you're generating and how you're managing your expenses. But the two do not correlate completely. They do over time, but in the short term, you could be very profitable and have no cash in the bank. I'm guessing there are plenty of people on this webinar who've experienced that exactly, where you're making money, but there's no cash in the bank. You don't understand how that could be. And so there's some KPIs we can build around specifically that issue. As you grow, more and more cash gets tied up in accounts receivable, in inventory, things like that. And that can be profit that's coming in, but it eliminates your cash flow. And then finally, to increase profitability. We're in business for a lot of reasons, but at the end of the day, it's to make money is a major one, right? You may want to impact your community and provide jobs and those sort of things, but you have to have profitability in order to do those things. So certainly increasing profitability through productivity, et cetera, is a major business objective. I always like the acronym SMART when we're talking about setting goals, and SMART stands for specific. It's got to be a very specific. You can't say we want to make more money. We can say we need to hit $100,000 this year, or probably more specific would be, we need our gross margin to go to be 76%, for instance. Measurable. You got to be able to measure. You have to be able to quantify it. Just saying we want to do better without any way of measuring it is not something you can work towards, and it's not something that you can really motivate a team to get behind, because it's just kind of a vague idea in the sky that frankly can change based on people's moods and other things. It needs to be attainable. Incremental improvement is really where it's at. I was in a meeting earlier this week with clients, and with COVID things happening right now, the business is a little bit shaky. They're going to be just fine, but things are a little bit tighter than they have been in the past. And we were looking at, we're not trying to cut expenses in half or double our top line or things like that. But you start looking around and you realize you save 1% or 2% here, 1% or 2% here, you shift some timing around, and all of a sudden you're in a lot better shape. And that gets to the attainability of those incremental improvements. The more we can focus on incremental improvements, and that doesn't mean once we hit one, we don't get to the next, but what's realistic in the time frame. Relevant, it's got to be something that makes sense for your business. That really comes down to looking in the right areas, focusing on things you don't have control over, or focusing on things that are too small, which I see happen a lot. People get really bogged down in the details of, what was our postage cost last month or something like that, and missing the big picture of, well, what happened to all this product we let go bad, or things like that. And time specific, we need to have the T in SMART stands for time. We want to put some time frames behind this, not just we want to be here someday. It's in 6 months we want to be here, and that's maybe where we back off a little bit on our goals and say, okay, here's our interim goal, and this is for this quarter. Here's what we want to be. Certainly, right now, the way business is going and the way people are having to, gosh, it feels like reinvent their business model to a degree. Every few weeks, sometimes it feels, if you were very heavy on having people come in and dine, or even just enjoy your tasting room, and depending on what state you're in, I know there are different rules all over for each different state, but there's a lot of reinventing things. So sometimes the time frame is, okay, what is this month going to look like? But we do want to set some time frames, some short-term and mid-term goals in identifying our goals, and then we build our KPIs out of what are the goals that we're looking to achieve. Next, we've got, who are the users? When we're building KPIs, we want to think specifically about who are using these performance indicators, because they have different goals and different motivations. And if we can build and track the KPIs that matter to the specific individual group, that's going to be a more meaningful metric for us. So in terms of users, first, I think of management, right? And the goal of management, that could be the owners of the business, that could be, your general manager, your production manager, things like that. But management, their goal is to improve business operations and profitability. So improving how much is falling through to the bottom line in terms of revenue, and then also getting more efficient along the way, right? If we can produce the same amount of if we can do the same amount of work and produce more profit out of it, then we become more efficient. And those are the kind of KPIs that management cares about. Staff, we like to bring them in on KPIs, and I occasionally I'll work with clients on establishing bonus structures and things like that, and that's always tied to it's almost always tied to some sort of a KPI, some sort of a key performance indicator. And for them, I find one of the biggest goals outside of, don't get away from thinking about like a bonus structure or an incentive structure, but feedback. Universally, we hear from staff in pretty much any business, they want more feedback. How am I doing at my job? Establishing KPIs, establishing some benchmarking for staff specific stuff is phenomenal. It's a really great way to give people a very meaningful feedback on how they're doing at their job. And just that alone, I find just giving them the information we see consistently causes an improvement in whatever KPI we're tracking. So just tracking it by itself and making that information available to your staff, whether it's, ticket average is obviously a good one for restaurants or even a tasting room, things like that. For your back of the house, it could be, efficiencies, things like that. Just starting to track those numbers, people are just naturally competitive, I think, and they tend to try and rise up, especially if you give an average and then people can compare where they are at the average. I try to stay away from, calling out individuals on stuff, although sometimes that in certain settings that is appropriate. But, just kind of so people have a general idea. But I find literally just, here as a team, we're here, and next month we're here. Everyone feels good about that, regardless of if it's tied to any incentive. That being said, tying it to an incentive is never a bad idea. So if we've got a bonus structure, things like that, if we want to do something like that, tying a KPI to incentives for our staff can be very valuable. Investors, let's make it really simple. If you're an investor, it may be a passion project. You may be excited about being a part of it. It may be family. We know how these things go, but ultimately the goal for an investor is a return on capital. So they want to know how's my money doing, and is it making me more money? And certainly in a industry like cideries, things like that, there's a longer ROI, right? We're not turning around, your money in 18 months, like if we were flipping houses or something like that, potentially. But they do want to know that we're marching towards that goal. And so if you're having board meetings or annual calls or meetings, things like that, having KPIs that really tie to that return on what is your money doing, how is it growing ultimately. And sometimes that growth is the plan is maybe we want to sell, or sometimes the growth is we're just going to keep doing it, and maybe we're going to, as the owners, we're going to buy out all of our investors eventually. And then banks, they use KPIs constantly. They're always using their metrics for determining whether or not to loan you the money, whether they think you have a viable business. Are you going to be able to repay us? And they call them covenants oftentimes when you're dealing with financing. But it really comes down to a KPI of how much ability did you have to repay this debt, and the ability to borrow more. You know, if we give you more money for more equipment, is that going to equate to more revenue, which is going to make it easier for you to buy this to pay us back? Things like that. So those are generally the users that we're trying to kind of manage to when we're developing KPIs. So let's talk about some more specific actual key performance indicators that we've used with clients and that are just kind of generally used in the accounting industry. Efficiency, right? Actual gravity divided by potential gravity. How much are we pulling out? This is probably a little bit more specific to some of the breweries we work with, because the wort extraction is a little bit of a different deal. But, you know, are you getting everything you're paying for when you're buying those raw goods? Are you using as much of it as you can? Obviously balanced against, there's a quality consideration. We want to make sure that we're using quality product, and we don't want to be squeezing so much out of our product that we're harming our quality. But if there are process improvements along the way where we can maintain quality and also get a little bit more efficiency, that's a very good thing. Total cost per gallon. This is a great number to be tracking as you go. It's a very good number for comparative month over month and year over year. This is all of your costs of goods sold, whatever went into the product, including your cleaning and your packaging. We see those get overlooked from time to time. I would include shipping in that now, as well, as we're seeing more and more being shipped. But certainly cleaning products often get forgotten, but that's part of the cycle. If you want to make, you know, quality product, you're going to be quality cider is going to require, you know, you to be using cleaning equipment. So we use our cleaning supplies in there, as well as our packaging supplies divided by our number of gallons packaged. Gives us our total cost per gallon. Similarly, our labor costs per gallon, you can see our kind of the calculation there can be a little bit more complex, but it's basically how many labor hours, and then we figure out what our labor cost is, our fully loaded labor cost, which is your all-in cost, including your workers' comp insurance and other benefits and things like that, per gallon produced. So if we're, you know, depending on how big of the batches we're doing, how much time did it take for us to get there. These are these are really the KPIs that tell us, are we doing well in production? I find often people at least know about these, or sometimes are even tracking them. Again, there's some real timing issues, especially with the cost of goods sold and with the labor costs. You got to have your accounting dialed in. So sometimes there's some opportunities there, but these are really the key performance indicators when we're talking about production. Sales, simply your sales expense ratio, your sales expenses divided by your sales attributable to that channel. If you've got one salesperson in a certain region, what are your sales in that region? How much is it costing you to have that salesperson, you know, their salary, their expense account, their mileage reimbursements, you know, all those sort of things, any samples that you're giving out, marketing. I know there's rules about, you know, what we can give away, but, you know, those are the expenses that go into that sort of a thing. That's going to be key. And if you've got, we've got plenty of clients we work with, and we sit down and we look at, I don't know if this sales rep is making or losing us money. So figuring out what's our break-even point on a sales rep is massively important. Average sale by account, kind of self-explanatory, but your total sales divided by your total accounts. And that can give us a real sense of, you know, you can look at the numbers and see who are our biggest accounts, but you can kind of figure out what your average is as well. And then you kind of know who's above and who's below that line. Work with your sales reps on how do we bring up those lower accounts, or are they worth our time? Are they worth our energy to be sending another, you know, just be sending a truck out of their way to go drop here or whatever? They're not even close to what our average is. What can we do to pull them up? What's great about that is you don't have to increase your account number, your number of accounts. if you can increase your sales per account, just like you don't have to increase the number of customers you have coming in the door if you increase your average ticket, right? And finally, revenue by sales rep. Again, coupled with what's our break-even point on our sales reps, that's really valuable information to have. I understand not all sales are done through a rep, so that could be your online marketing, driving. I was just on the phone actually with the client earlier today talking about an online marketing program they did that was very successful. And so looking at what was our cost into that versus what did it generate. And sometimes we look at that and realize, boy, boots on the ground is pretty expensive compared to doing this stuff online, or vice versa. Stuff online isn't really generating much for us, whereas having a person going out and knocking on doors is really working for us. So again, starting to capture these numbers, track them, monitor them, regularly. If you have someone as a sales manager or someone who part of their job is being a sales manager, these are some of the numbers we want to look at instead of just like, okay, where's revenue this month, which is not uncommon. What happens is, you sit down and say, well, sales are down. What are you doing? These will give us a little bit more specific. We're able to drill down a little bit more. Well, hey, this sales rep isn't functioning, or this sales channel isn't working, or why is our account average dropping? Or, people need something more seasonal. Obviously, that's generally the big push is what's new. So then we get back to our production guys and get some guys and gals and get some more interesting stuff in the mix. I know a lot of you know all this stuff, but this is really where the rubber meets the road is implementing this kind of stuff. If we're dealing with a restaurant situation, a lot of our KPIs around that are going to be our back of house and labor costs. If we've got our kitchen staff over food sales, this number is really critical if you're operating a restaurant, and even if you have a limited menu, really monitoring that is going to be critical. Between your back of house labor and your food costs, that's going to be a really key driver to whether or not we're profitable on the food side of the business. For my clients that are, say a brew pub or a cidery with food that they're selling as well, kind of a restaurant combo there. I like to track the restaurant operations separately from the cidery operations. Those are really two different business channels, especially when you add in the fact that oftentimes there's a wholesale and a distribution channel, which is really a third channel, because we want to know that the restaurant is standing alone. Standing on its own. Similarly, we want to know that the alcohol sales are standing on their own. Generally, that's not a problem. The concern sometimes is the food sales, or is the restaurant sales kind of dragging down the rest of the business. Obviously, there are licensing issues that can come into play with that. There are also just the reality of you may need to have food on premise to drive your customers that are going to be then buying more to drink. So just because you're losing money potentially in the restaurant side doesn't mean you throw the whole thing out, but it is definitely something we want to know about. And obviously, ideally, we're making money, both food and alcohol. Front of house labor, similar. This really gets down, in my experience, to who's the GM on the front of the house, making sure we're cutting people when they need to be cut and bringing people on when they are, so that we're not overstaffed relative to our customer load at any time. And this is front of house wages divided by your total sales. So including your bar, your alcohol sales, whatever's being sold on premise, we want to see that number. That's generally going to be a smaller percentage. Depending on different, if you have different areas, if you have like a big outdoor area that kind of runs as one thing, and then you've got a bar area, sometimes we'll even separate those out so we can see. Oftentimes a bar, there's a much higher profitability. You got one bartender back there, or two bartenders back there pouring cider, and people ordering they tend to have higher tickets and things like that versus somebody who's doing outdoor patio dining kind of a thing. So again, we may want to monitor those separately, but absolutely, if you are running food, back of house labor, food costs, front of house labor, you got to be tracking those. And if your accounting system isn't set up to break apart labor into those categories, you need to get that set up so that you can track these numbers. In-house versus guest. If you're bringing in guest beverages, whether it's beer or cider, even wine, we want to track those separately so we know. Obviously, I say obviously a lot, maybe not obvious, but we have a lot more profitability on our in-house stuff. So if we're seeing that number start to slip, maybe we need to be doing some sales, kind of promotions with our front of house people to make sure that they're pushing our product, not pushing our product, but encouraging, getting our customer base excited about drinking, what we're producing, and a lot of that comes down to telling the story and things like that. But tracking those numbers can be beneficial. Generally, in-house people are coming to you to try your stuff. So that's not usually a major issue, but certainly something worth tracking. Food and beverage as a percent of sales, absolutely valuable. Knowing, what percentage of the top line is coming in as people drinking versus eating. And then we talked a little bit also about average ticket. If you can do little things to boost that average ticket, that goes a long way. A lot of times, you've got a lot of sunk cost into getting somebody sat at your table, and the amount of time that they're going to be there, and the kitchen staff is already there, the servers are there, the bar, everybody's already there. If we bump their average ticket by $5, that $5 almost falls through to the bottom line. There are some costs associated with whatever they're buying, but so much of it has already been absorbed in their overhead and things like that, that a lot of that number falls through the bottom line. So I really like monitoring that average ticket price. And sometimes that's not as simple, but sometimes it's as straightforward as raising prices. Obviously, we've got competitive pressures and other things preventing just raising prices, but sometimes the answer is we got to raise prices. If we know all these numbers, then we know really clearly if we need to raise prices or not. If we don't, we're kind of shooting in the dark. Our financial KPIs. So this is, your monthly management meeting. You're reviewing your financials with your bookkeeper, with your CPA, just with your finance team, by yourself, at the dinner table. What are the things we're looking at? Some of these are similar. Revenue per gallon. How much are we making on a gallon of cider that we produce? That'll change based on your distribution channel. If it's going out wholesale in bottles, it's going to be a very different revenue number than if you're selling it across the bar in the tap room. So total revenue divided by gallons sold. If we're talking about a restaurant situation, peel out the food. We're just talking about specifically the beverage production. Your profit margin per gallon is your margin, which is your sales price divided by your cost of goods sold. So how much money is left over to cover your overhead, profit, things like that, after you pay for the raw goods and labor that went into producing that cider. Profit margin divided by gallons sold. Your operating overhead per gallon. So operating overhead is basically everything that's not a cost of goods sold. Utilities can sometimes get allocated some utilities into cost of goods sold. Oftentimes at the smaller level, it's not going to, and I'm totally fine with that. Rent, insurances, things like that. Your overhead divided by your gallons sold. What percentage of every dollar that we earn is going just to do the management stuff, pay the accountant, pay the attorney, pay people like that. Income per gallon, that's going to be what's your net income. EBITDA is your earnings before interest, taxes, depreciation, and amortization. It's a fairly commonly used number in the finance world, but basically it's net income. What's your bottom line per gallon? How much am I actually making on this gallon that was produced? Debt coverage ratio, we talked a little bit about some of the users of KPIs, and one of them, of course, being banks. They care a lot about this number. Your income divided by your debt service. How many times are you earning what is required to cover your debt? You can be profitable and still not have enough income to cover all the debt, because your debt is not an expense item. So they want to make sure that we're able to service that debt. Certainly, if you've gone out for a home mortgage or something like that, it's obviously a very big number that gets paid attention to there. Your debt to income ratio. So that's an important ratio to cover. And cash conversion cycle. This is one I like a lot. And I do a talk kind of just on this and cash flow in general. Because it's a really important concept to nail down. And I'm not going to get too far into the weeds with it here today, but your cash conversion cycle is really how much cash, if you think about cash as an asset, but as an asset like you would, raw ingredients, how much cash is just tied up in your business operations. And why it's important to understand that is because as you grow, that cash demand starts to grow. And so even though you're profitable, it's just getting soaked up into this machine that is continuing to grow. If you stay static, generally this isn't a problem. But as you're growing, more and more cash gets sucked into this machine of inventory and accounts receivable. So your cash conversion cycle tells you how long does it take, if my profit is, let's say my profit is 50%, how long does it take for me to take this dollar and turn it into that $1.50 that I expect based on my business model? If you tell me you're doing that, that's a great business. But if it takes you 9 months to turn $1 into $1.50, well, you still have all your overhead you have to cover for those 9 months. You might need $10 just in the bank in order to turn $1 into $1.50 because you got to survive that time. As you go, if you stay static, of course, then you're earning on previous months. But if you're growing, you know, you need $1 to turn $1.50 today, and then you need $2 to turn those into $3 tomorrow. But your cash needs to go up. So the cash conversion cycle, if you're finding you're running into this problem, is a great number to monitor. And really what it comes down to is your number of days in inventory. This is in dollars. The days of inventory you have on hand. So how much raw good do you have? How much finished product do you have in the walk-in waiting to be sold? Plus your days of accounts receivable in dollars. How much accounts receivable is sitting on the books, which is really money you've earned, you just haven't received it yet. Minus your days of accounts payable, because now you've borrowed money, essentially you've received services from somebody else, maybe even inventory items. And as that number grows, it's actually reducing its debt basically, but it is reducing the amount of cash you needed to put into the business. And those all combined, days of inventory plus days of AR, minus your days of accounts payable, gives us our cash conversion cycle. But basically the number of days it takes for me to spend $1 and get whatever I'm going to get on the back end, $2, whatever my profit margin is. Again, I do a whole talk on that, so it's a little bit complex or around those topics, but this idea that as you grow, more cash, even if you're profitable, can be flowing into the business is a key concept, I think, for new business owners. And there are ways that we can manage it in large part by managing our inventory days, our AR collection, and our AP. KPIs by life cycle. So if you're depending on what life cycle where you are in your business, you're probably going to be monitoring different KPIs. Some of these are because as you grow, you kind of, some of them just are automatically being covered by other things, and others are just, you just need to look in different places at different times. So when you're starting up, your gross margin, how much money do we have left over for overhead after we produce a gallon of cider? That's going to be big, and you know, from day one, that's an important number to know. Revenue growth at the startup phase, you know, you got to get to a certain point to be sustainable. How quickly are we growing to get there? You start at day one, day zero with zero revenue. How quickly, you know, 10, 20%, 50, 100% a year is not uncommon. It certainly wasn't in the past, and we still see it, but that's because you start very small, so it doesn't take much to double, right? But monitoring that revenue growth percentage in the startup phase is huge, because in part it'll allow us to project a little bit where we think we're going to get to, you know, certain break-even points or time to expand, things like that. And if you have debt as a startup, monitoring your debt coverage ratio is huge, and I guarantee you your banker is paying close attention to it when they ask you for your tax returns or for your financials. That's really what they're looking at, monitoring that debt coverage ratio, both for, are you meeting your covenants for your debt current? Frankly, there's not a whole lot that happens there other than as long as you're making your payments, it is what it is. But as you grow, you're going to want to expand. Oftentimes that expansion has to come with some debt financing, and therefore we got to know what our debt coverage ratios are so that when we go to our banker, we know we're going to look good. If we go to them and our debt coverage is terrible, they're not going to help us. And now we've dug ourselves a hole that we got to dig out of before we can get in front of them again. Whereas if we kind of know those numbers ahead of time, we know where they need to be, then we can kind of put together the package that makes it a compelling story for, here's why you should loan us this money and how it's going to happen. After startup, we get to that rapid expansion phase, ideally, right? Those first few years tend to be a lot of growth. There's kind of a sweet spot for how quickly you really want to grow. But in that rapid expansion phase, you know, the KPIs that I find to be the most meaningful, that allow you to make the most valuable business decisions. Talked about that cash conversion cycle, our cost per gallon, sales by rep, our labor costs, front of house, tap room labor costs. Those are some really key areas. We've already established our gross margins and things like that on the startup side. We're still going to pay attention to those, but as we're growing, we hope that locks down, and hopefully as we grow, it starts to get a little bit better as we're able to leverage economies of scale to do bulk buys and things like that. Streamline some of our sales processes, et cetera, et cetera. So some of these other other numbers can be effective. And then at maturity, once you're a mature company, really it gets down to efficiency, right? You're out of the phase of massive growth. Hopefully you're still growing by a couple % a year, or sometimes more. Certainly there are companies that we all know of that are mature that have crazy growth, especially in the some of the alternative beverages are going crazy right now. Obviously, seltzer is a thing that's really revolutionized some of the financials for some large mature businesses. But in maturity, it's really about efficiency. Right. So what are we doing to, make sure that our business is running as efficiently and being as profitable as it can be? Cost of goods per gallon, again, cost of goods sold per gallon, going to be huge. Overhead per gallon, as our overhead stays fixed, or excuse me, as our top line revenue stays fixed, now we shave a % or 2 off of that overhead, or it goes up by a % or 2. That can be a significant hit to our bottom line. When you get to a certain size, a % or 2 in overhead is 6-figure swings, 7-figure swings sometimes in profitability. Average ticket, if you're selling through the tap to the tasting room, or selling through the restaurant, bringing that average ticket up. Again, you're not having to bring any more people. You're not having to fill any more seats. You're just increasing the dollar amount. And return on investment. We talked about our investors at the mature phase. That's really where they're anticipating an ROI, and so that's kind of where we get to the point of really looking at that. Implementation. So it's great to have an idea about what KPIs are, where they come from, maybe even which ones are good for our business, but we do have to implement them. And that's where kind of the rubber meets the road. Sometimes that means you need to bring in a third party to kind of help implement that, because you're pulled in a lot of different directions. But it's key to identify a few things when you're implementing your KPIs for your business. The first being, who's responsible for tracking and reporting this data? Is it your outside bookkeeper? Is it your in-house bookkeeper? Do we have systems in place, our POS system or our management system that allows for us to track these things fairly automated? Or does somebody have to go around once a week and gather certain things and put it into a spreadsheet? That's not uncommon. Once we've identified a responsible party, we need to have a reporting time frame that's consistent. Consistency is really the key to these, because a single KPI is just a data point. What we're watching for is trends, and so we want to have a reporting time frame that says it's consistent. If you're talking about your financials, generally we see people deliver financials between the 10th and the 20th of the following month. Like, it's time for reconciliations and for stuff to get cleaned up, etc. And that would be an appropriate time frame, in my opinion. That is for KPIs to be delivered as well. Finally, next, who's responsible for improving this metric? Tracking it is great, seeing a trend is great, but if we're all sitting around the table looking at each other saying, whoa, that got bad, somebody should fix it, we need to have somebody identified. This is my baby. I'm going to take this and I'm going to be responsible for getting this metric where it needs to be, or holding it steady if we're happy with it. Somebody, if we're going to track it, let's have somebody responsible for managing it as well. And I think it's good to reflect from time to time on your metrics. Is this metric giving us actionable information? It's not uncommon that you are managing to a metric that used to be meaningful, and either you've gotten good at business at this part of the business, and so therefore it's just kind of consistent and it doesn't tell you a whole lot, or maybe it never really was that valuable anyway because it was stuff out of your control, or whatever it is. So sitting down and saying, is knowing this number allowing me to make a decision that's going to improve my business? If not, why are we wasting people's time with it? Let's figure out something else that is. And if you're using it as a part of an incentive program, I do want to hit on this. We want to make sure you've got really clear transparency and timing on gathering the data and calculating it. This is a morale issue really with your employees. If you're using KPIs to incentivize people with a bonus or time off or whatever it is, we want to be really transparent. Doesn't mean they have to see your books and they can go audit your books, but whatever process we're going to use for figuring out these numbers, let's be really transparent about how we're getting to this number and what actions you're taking are affecting where we're getting this number. Because otherwise, I've seen it happen where you run into some morale issues where there's maybe some distrust, or they feel like the numbers are being skewed to kind of prevent them from getting a bonus. I have never seen that really happen, but you can have employees that start to feel that way. And so really being transparent about, this is how the process is, here's where the data is coming from, you guys can look at it anytime, or it comes, whatever it is, it's just important. So just something I like to throw out there, just telling people a number, like, oh, we didn't hit our number this month, that's not going to fly. Or even we did, is cool, but if people can really see it, then they can really work towards it. And that's a lot of the goal here, is to get people excited about kind of working towards a goal. Integration. I think it is wonderful to use a management software to do this integration. There can be a lot of work in doing this, and that's one of the advantages of using like a management software. So certainly I spend as the accountant a lot of my time in QuickBooks and things like that. We have a number of clients that use a variety of management softwares. Obviously, Ecos is presenting here, the kind of sponsor here. They've got an excellent one. They really do. I have a number of clients that use it. It goes well. And kind of what are some of the things that a management software can help facilitate, so that all this stuff we just talked about isn't this extra manual process. I hate walking into a business and just seeing a bunch of extra spreadsheets on the side. We got our accounting over here, but here's the 19 spreadsheets I have to maintain in order to know where things are at. Well, if we can get one piece of management software that's going to do some of this KPI tracking, as well as some other stuff, as well as feed the accounting system, that's a great thing. And so what a good management software is going to do is, first of all, it's going to be generally in real time, and it's going to be across the entire business. The employees aren't having to go into the books, updating their data, right? So this could be a spreadsheet where, okay, what did we produce today? What did we produce this week? Let me punch those numbers in so that I can manually move it from this spreadsheet to that spreadsheet to that spreadsheet. It's doing it, automatically. So that allows communication and KPI tracking to become streamlined and centralized. And I think that streamlining piece of it is really important. As something's moving through a process, especially as there's a handoff between one person and another, the streamline gets rid of that extra email or that phone call or that text message, and we just kind of streamline the process flow. We frankly do that in our business, and we got rid of, hey, this is ready for you to look at kind of emails years ago, and it's just made it so much more efficient. We all know where to look. It's more communication by less communication almost. Increased accuracy in cost and revenue allocation. We talked about that, pretty at the beginning here, but we have to work on our timing to associate when we're generating revenue with what expenses are associated with that revenue. And being able to, the more accurately we're able to do that, the more accurately we're able to really monitor some of those KPIs. And that results in reduced margin of error on the bookkeeping side of things, on the accounting side of things. Having a sync between your accounting software and your management software can really help to automate a lot of that and really help streamline the process. Some of the examples of some of the things that we want to see synced. It avoids extra journal entries, again, extra outside spreadsheets, calculations, things like that. Cost of goods sold at the finished goods level. How much of my cost of goods, well, first of all, is sitting in inventory, but then how much of it, how much of our finished goods is rolling through to cost of goods? Is that associated with the inventory, with the invoice where the revenue was generated? Cost of goods sold for work in progress loss, inventory adjustments, transfers, things like that. So tracking some of that, a little bit more of that minutia in terms of what's called shrinkage or other things like that, which helps us, again, to feed into some of our efficiency KPIs. Certainly, integration allows us to integrate invoicing and allocate income and things like that with some of our customers, which is certainly a good thing in terms of some of the sales tracking KPIs we talked about. We want to make sure AR and AP, that again, AR and AP really come down to the timing issue and affiliating those income and expense items with each other so that they're matching. Journal entries are going to allow us to keep our balance, that inventory accurate, which is powerful for that cash conversion cycle we talked about, things like that. And, just being able to track things like, your KEG deposits and credit memos, things like that, to make sure that all that stuff is being tracked correctly. Almost invariably, when we walk into new accounts, the KEG deposit account in particular is not right. It's usually just been growing over time. And then all of a sudden we find out, oh, we went to leased kegs a year ago. That's all gone now, or whatever it is. So that one in particular, it just kind of strikes me because we hit that just about every single time. And yeah, so again, obviously there are others out there, but ECOS is a great one. I work with them with a lot of my clients, and they're, you know, that all-inclusive inventory management allows you to just really follow your product through the steps, the costs through the steps, and it allows you to kind of analyze what's happening, where are we efficient, et cetera, et cetera. So, you know, I highly recommend something like that because, you know, you're going to spend money paying somebody to do a lot of this stuff, or it's going to distract you from being able to do some of the other stuff that you're really doing as well. In terms of challenges on KPIs, you know, I think using an integrated solution like that really can help to mitigate a lot of these challenges. But the challenges are kind of similar to kind of some of the responsibilities, but you got to have accurate information. Again, I get back to inventory because that's such a key piece of it, but, you know, making sure your labor, things like that, it's got to be timely. It's got to match, right? So you got to match your revenue and expenses. If I can tell you what your KPI from 9 months ago was on some key issues, that's great, but that's not really that actionable because I don't know what it is today. So that's really where we got to get to a place of getting a regular report. And if it's in real time, hey, that's cool. If people can log in and click and see it, you know, when they log in for their shift, or as a business owner, I can sit at the end of the night and scroll through my phone and see it. That's awesome. But we got to have some sort of regularity to it because, again, we're tracking trends. We got to have buy-in from the users. I've hit on the staff stuff a couple of times, but we got to buy in that, okay, I understand how this is calculated. I understand how this affects my business bottom line. And that, of course, gets us to the challenge of you've got a lot of other distractions in running your business. And so this is really a matter of working on your business rather than working in your business. Working in your business is being out there, you know, pouring or being a part of the production team, you know, taking care of packaging, stuff like that. Working on your business is figuring out how do we make our business more effective. What you're doing right now is working on your business, which is a great thing, being a part of the classes that have been going on the last couple of days. So I always like to try and end with some key takeaways for the day. Just what are, you know, out of all the stuff we talked about, what are the things that we can take and actually implement in our business so that this doesn't just be something we listen to and walk away. And really, hey, what are the key components for your cidery success over the next 12 months? And this next 12 months is different than it was, you know, 6 months ago when, you know, the last time I gave a presentation like this, things have changed. So that may be a little bit different, but what do you really need to do well? Where do you need to execute in order to ensure your cidery success for the next 12 months? Once you figure that out, get the team on board. If that's your in-house accounting team, if that's, you know, you've got outsourced bookkeepers, if that's your production team, your sales team, whoever it is, identify what those critical components are. Let's bring everybody in, get them on board, make sure they understand how this stuff is calculated, why it's important, what actions they take can affect it. Set that reporting timeline. Again, timeliness is so important. If we don't have it timely, it's meaningless data. So it's got to be timely. It's got to be regular. If it's in real time, that's awesome. We can track trends over time. That's the best. Make sure you review the reports. It's not uncommon for this stuff, especially if it's an outsourced thing. They send you the package once a month or whatever it is, and all of a sudden you realize you haven't really reviewed it or aren't really monitoring it. So you gotta buy in yourself, get other people to buy in, and part of that is just, hey, make sure you're actually paying attention to it. And like I said, I recommend 3. If you've got multiple departments and you have different department heads, they could each have a couple, kind of a thing. But really, I recommend just pick a couple, and you don't have to eat the whole thing at once. Just take a small bite, pick the stuff you think is going to be the most valuable, and start there. And once you kind of get something dialed in, maybe you add something on. But if you try to do much more than 3, in my experience, it's just too much. So, I like the acronym KISS. Keep it simple. Like, we're not trying to reinvent the wheel. We're not trying to go. We don't need to have the world's most sophisticated accounting and KPI system today. But let's start with something, and once we get really good at that, then we can move on to the next. So those are kind of my keys on key performance indicators, creating them. It's always weird doing these webinars, although we're getting a lot more comfortable with it. There's no feedback coming back to me. So for all I know, I just talked to myself for an hour, but hopefully that was valuable information. Certainly, if you have any questions or comments, I think we've got a questions set up here that'll be popping up as soon as I kind of wrap up. Also, my email is down there. It's lpc@M.U.N, CPAs.com. Feel free to reach out to me directly. I'd be happy to sit down and talk with you, do a complimentary consult on some stuff, or if you just had some questions about what we went over today, I'm more than happy to sit down and talk to you about that. And with that, Emma, I'm going to hand it back over to you. I think you were going to run some questions by. I think I may have seen a question pop up in the Q&A. Let's see what happens if I click here.
Yeah, it should. I see a question there. You should be able to access it as well.
Awesome. Yeah, I gotta minimize my screen. Sorry, I gotta. Oop.
I can also just read it to you if that's easier.
You know what? That would be easier if you don't mind. Sorry about that.
Okay, John Hoyos, sorry if I didn't pronounce that correctly, says, what do you think is an appropriate range of revenue growth for the first 3 years of a cidery?
An excellent question. We see a little, I mean, if we're starting, it depends a little bit on your capacity. I'll say that. I would say for the first 3 years, it's not uncommon for us to see, maybe year 1 over 2, 100% growth or something like that, but it's going to taper off. I think if we're talking about long-term sustainable growth, where I've seen people grow well and not get too much into trouble, is like 20 to 30%. And in the first 3 years, it'll probably be higher than that just because you're starting at such a low spot. So it may be 100%, 50%, maybe 50% again. And from there, we kind of see it tend to taper off. It depends a little bit on your capacity and, what you're starting with in the first couple of months. But I think in terms of sustainable growth, 20 to 30%, and 30% is probably at the top end because just, again, so much cash is flowing back into the business and things like that. So certainly can be higher in, like I said, in the first couple of years, but longer term, I think that's where it's sustainable, and where I've seen, unfortunately witnessed, people grow too fast, just try to bite off more than they could chew, and they had the growth, but they just couldn't keep all the pieces in the air. Your debt load becomes really burdensome when you're growing real fast. So that's kind of my 2 cents on it. Every situation, of course, is very different. We've got some unique situations where that's totally untrue. But if you were targeting something or trying to make a plan sustainably, I think 2030 first couple of years is going to be higher than that just because you're starting. So, at zero.
Great, thank you. Are there any other questions while you've got a CPA here and we're ready to go? We'll give it another sec.
No sweat.
Yeah. Okay, someone else is asking, what's the most important thing to focus on regarding finances as a new business?
The most important thing to focus on, that's an excellent question. I would say cash flow, actually, really monitoring your cash. What is your cash position day over day? Even more so than the P&L. Certainly some of that operational stuff we talked about, very important, and you're going to need to get that, and you're going to need to get that right away. But when you're just starting out, just knowing where your cash is, what's coming in next week, next month, what's our outflow of the next week or next month, that's really, I think, a key place to start. And there's a lot to go from there. But if you want to know, day one, what do I need to pay attention to? Cash flow.
Okay, and then a third question. What are the typical average gross margins for cider products?
It depends a little bit if you're selling it over your own tasting room versus going out to distribution. But oftentimes we'll see gross margins, 50 to 75% is, I know that's a large range, but it can depend quite a bit. Straight over your tap room, depending on your model, could be as high as, say, 90%. That's pretty high. I don't see that very often. And certainly once you bring a distributor in, depending on what you're doing for packaging, et cetera, you know, it can be a little bit worse than that.
Okay. That looks like that is the questions that we've received. So Lou, I just want to thank you again for your time and for putting this whole presentation together.
Yeah, my pleasure.
Again, for anyone here, this will all be available in a video if you want to go back through, see the presentation. Here's Lou's info if you want to ask follow-up questions, or like he said, have a little mini consults. Doesn't seem like a bad idea as everything is in such flux right now. But yeah, thanks to everyone who joined us. Thank you so much to ECOS, who's been our partner through the last 4 sessions of Cider Business School. It's been such a pleasure to have everyone here and hear all your great questions, meet all the great presenters and facilitators. So best of luck to everyone in the coming months. We hope to do more Cider School coming up, so keep an eye on Cider Culture's website, ciderculture.com, obviously, and our socials for news about that. Please follow along with ECOS, who also have lots of resources that they can share to help your business grow. And just thank you all so much. I'm really thrilled to have wrapped up this 4-week course, and thank you all again.
Thanks for having me, Emily. I really appreciate it.
Thank you. Bye, everybody.